Welcome to Columbia Business School Executive Education. I'm Mark Roberts, and I'm here today with Professor Shiva Rajgopal for today's webinar, Mastering Investor Relations for Strategic Growth. Just before I introduce Shiva, there's a few quick points for me to run through. A recording of the webinar will be sent to you in the coming days, and we'll also send you a copy of the presentation. Please note that you can follow us on LinkedIn for our latest news and updates by searching for Columbia Business School Executive Education. And finally, and most importantly, please feel free to submit any questions you may have using the Q&A box, and we'll try and get to a few of those towards the end of the session. It's now my pleasure to introduce Professor Shiva Rajgopal. Shiva is the Roy Bernard Kester and T.W. Burns Professor of Accounting and Auditing at Columbia Business School. He's one of the world's leading experts on measuring how well managers serve as responsible stewards of their corporation's resources. His extensive body of work covers a wide range of contemporary issues in financial reporting and governance, such as accounting restatements, frauds, SEC enforcement actions, efficacy of board and executive compensation schemes in delivering shareholder value, whistleblowing, and the key importance of corporate culture as an underappreciated economic asset of the firm. Shiva, thanks so much for your time today. I'm going to rejoin you towards the end of the session, but for now, it's over to you.
Thank you. Thank you, Mark. And thanks for 196, an increasing number of people who've given us their time. Thank you. Appreciate that. So this is a quick session about investor relations. What does investor relations do? I think it's highly underappreciated, but a hugely important function in most public companies. And broadly, if I were to say, here are the 3 or 4 or 5 things that the IR people do. A lot of it is about messaging. It's about communicating your story. It's about finding the right investor clientele. It's about dealing with things like shareholder activism, engagement with proxy consulting firms, especially staying on top of regulatory changes, worrying about the liquidity of the firm, and the general sense of perception that the brand has in the minds of investors. It's a little bit like a branding exercise for shareholders, as opposed to, say, the branding exercise that you see in marketing in the product market. And I thought it might be a fun thing to kind of go over a case study of a disaster. Disasters are always fun to talk about. So this is a company called Lyft, and for people outside the US, it's basically a clone of Uber, if you will. It's a competitor to Uber. You may not have Lyft in your country, I don't know. And what's the case about? So every quarter in the US, we need to report earnings numbers, and it may be 6 months or so in your jurisdiction. And then when you do that, you file a press release with the SEC, and it's called an 8K. An 8K is just technical jargon for a market-moving event that the SEC needs to know about. And the funny thing about this particular event of the press release was there was a big typo that kind of crept into the press release. So as you can see in my second bullet point there, it says adjusted EBITDA margin expansion was approximately 500 basis points year over year. What does that mean? It means 5%. So the margin went from like 1.6% to 6.6% if you read the statement literally, which is, by the way, an incredible increase. So anybody who's in this world will appreciate that that is highly unusual and bizarre. So it turns out that the margin had only gone up by 50 basis points, which is like 0.5%, as opposed to 5%, which is a big deal. And why does all this matter? Well, of course, the markets went crazy. So many of these announcements are usually made after markets close, but there's still after markets trading. After 4 p.m. when the NYSE closes, a lot of these announcements tend to get made then to avoid issues like this. But that's exactly what happened. The stock went nuts. The stock went from something like $12 to $20 a share in like 30, 40 minutes. Which, as you can imagine, is an incredible return, 100+%, 150+% return, because the market thought, wow, I mean, Lyft had figured out some magic formula to raise margins by like 500 basis points. And the somewhat embarrassing, difficult thing for IR here is, I think, at least from what we can tell from the outside, I think the company did not know that there was this problem. So as is typically the case. After these earnings press releases happen, there's a conference call. And then for people who are not familiar, the conference call is basically like a stress interview where, like, analysts show up and they ask you questions, and the CFO tries to take these questions, and the CEO is also in the room usually. And these are, fairly stressful events, especially for the CFO. And then, maybe the analysts notice, but that there's this one particular person, Nikhil Devnani, who asks the CFO of Lyft, what really happened with the EBITDA margin expansion? Was it like 500 basis points or 50 basis points? It looks like it must be 50. And then the CFO says, yeah, it's 50. You're right. And there's a correction in the press release. Maybe this is the time when management inside Lyft realizes there is a problem. But Lyft doesn't issue a corrected release for quite a while. And I have the timestamps here, 6 p.m. It sounds like it's not a lot, but it is a lot, because remember, between the time the announcement comes out and, till 6 p.m., or at least when the conference call is live, the market thinks that Lyft has suddenly become a highly profitable company. Many issues with this whole incident. 35 separate research analyst reports immediately go out right after the announcement, which generally makes me worried as well in general, because analysts, why is somebody not raising questions about such a massive increase? Are we all so worried about speed that we have forgotten to worry about accuracy and relevance? These are questions we can discuss if somebody wants to at some point. But in the interest of kind of going through the whole case, let me actually move on. So why is this an interesting problem? Because there was a big short selling interest in Lyft. So 12% of Lyft's outstanding shares were shorted before this announcement came out. And to just give you a comparative sense, 12% is a lot, but it's like 2% for the rival Uber. And the aftermarket, the after hours trading was mostly the shorts covering up their positions, and of course, they lost a tremendous amount of money because the whole idea of shorting, as you know, is that you're expecting the price to fall as opposed to go up. Of course, these things have compliance and regulatory implications. So, predictably, a class action lawsuit gets filed. For people outside the US, it's important to appreciate how litigious we are as a country. So, the lawyers are quick to file a suit saying you deliberately misled us. It's not an error. The case just settled, I think, a couple of days back. Lyft did get away with things. Nothing really major happened to Lyft. But it is still an interesting cautionary tale. And on the slides, you'll notice I have a CNBC reference. That's actually a fun video where the CEO of Lyft does a brilliant job. He comes out and says, look, I'm sorry. He's David Risher, CEO of Lyft, who I've known for a while, master communicator, says it's on me, and then quickly brings the focus back to customers and employees, and how employees worked extremely hard to deliver that great quarter, and how customers are supporting them. There's some interesting conversation in the video, which you can watch maybe after our conversation here, about Taylor Swift, because this was during the time when Taylor Swift was holding her concerts, and there was a massive lift, if you will, to Lyft's earnings numbers. And then the interviewer asks the CEO, is that like a temporary thing, or will that go up? That's the other big issue in IR, right? People are always trying to understand, how do you separate transitory or one-time boosts to earnings or revenues from something that's more systematic or persistent? And the theory, of course, is obvious. You assign an earnings multiple of, say, 15 or 20 or 25 to something that repeats, but you assign a multiple of just 1 to something that's transitory. So that's what the market's trying to figure out. So I guess that's part of IR's job as well. How much do you want to communicate about expectations management in terms of what is persistent core earnings versus what is transitory or one time? And kind of abstracting away from the case, is there a general message here? It turns out earnings errors are actually surprisingly common. There's a nice Bloomberg headline here which says gaps have been piling up a week after the Lyft typo. So I guess, just like any case, we want to close with some takeaways. What does this mean? What should we do? What should we not do? So here are a few tactical lessons, if you will, for IR. The first point is rather obvious. I mean, these releases and calls are stressful. Lots of media attention devoted to these calls, especially for very visible companies, especially for companies where the short interest is high because the short sellers are watching. So the margin of error tends to be pretty thin. So, that's probably an obvious point. So something more important, maybe implementable, often said but ignored, worry about the details because, we review the process once every 12 months, once every 24 months, if possible. I like the third idea, a pens down rule 48 hours before the release, because there's always pressure on most of us to perfect a word in a conference, in a PowerPoint or, in the wording, or there's usually a last minute suggestion from someone, maybe a board member saying, maybe this is how we should message this. That's counterproductive and can be, it's an obvious point, but I think it's worth making. Last minute changes can be killers. A related point, shrink the room, especially in young companies which have just IPO'd. There's a tendency for too many people to be involved in the earnings process. Maybe we just want to keep that number of people small. I mean, they're all well-intentioned. They understand it's very big. Being public for some of these companies is new. It's a new experience. But again, common sense, keep the core team short and don't let them, get scattered or whipsawed or disturbed, at least for 48 hours before the live conference call. Recommendation number 4, is it? Yeah, 4 or 5. That's actually more substantive, and this you have to worry about. Are these 4 groups in the company really aligned, and are they really talking to one another? The PR group, the legal group, the finance group, the compliance team, because these things have compliance consequences. And as we discussed, there was a lawsuit. If the SEC wanted, it could have gone after them as well, perhaps. These are very visible events played out in real time in the media. Now there are so many modes of reaching people. The media, there's like social media, there's television, there's press, and there's the blog sphere, and Twitter, and a bunch of other things. The last but one point is also a deep, important point. I've seen this happen a lot. Is there a single source of truth in our information systems? Because a lot of companies are at different points in their journey in terms of their sophistication of information systems. And some are on spreadsheets, some are on, more ERP type systems. Are they all talking to one another? That's kind of quite important. Otherwise, we get into trouble. This happens still, predictably happens again and again, especially with legacy established companies who've just been building layer after layer in terms of systems. So it's a bunch of band-aids. And there's never usually a good time to rip all the band-aids, and there's usually underinvestment. People don't want to necessarily put a lot of money into revamping the system. It also affects, product and service functions. So that's something to think about. And last but not least, prevention is always better than cure. Easier said than done, I guess. But so obsess about the details. Pens down 48 hours before the release. Shrink the room. Make sure that your teams are aligned. Most important, don't underinvest in information systems. Make sure there's a single source of truth. And hopefully some of these problems then, don't happen in your company. Just leave this, just to keep the conversation light and fun. This tweet out there in this context, and the video is on the chat, I believe. So if you have a moment, maybe after the call, you could probably play the video. I think it's nice. It's good to see the visual affect and how Dave Risher, the CEO of Lyft, comes and does damage control. So it's quite powerful. So it's kind of worth seeing for that reason. So we could stop here, maybe, Mark, and we could either show people the video if you like, or we could go to Q&A, or whatever else you think is the best use of our time.
Yeah, thanks, Shiva. I think great if people want to follow up and watch that video in their own time. That's probably the good way forward. And we've had quite a lot of questions coming in, so I think you've given us really some great tactical lessons. It's been really good to hear about the challenging Lith case. But if we can spend a bit of time now in this short session tackling some of the questions that the participants have had, I think that would be great. So if you're up for it, can I fire some questions?
Yeah, absolutely.
Yeah. All right. So says, how should investor relations communications be shaped during times of crisis versus times of growth?
Again, I like talking about case studies because I can, pontificate as my profession expects me to. I'm a professor after all. But the crisis story, I think the best case I've heard of is the J&J case. I don't know whether people remember this. It's been a while. So Johnson and Johnson, the so-called Tylenol incident. So there was a rogue worker who actually inserted, I believe, arsenic, which is like a deadly poison in the Tylenol pills back in the day. And this, you can imagine, is a mega disaster for the brand. People actually died. You pop in a Tylenol and you just die. And the way J&J, Johnson & Johnson, handled this crisis was just brilliant. Basically swiftly recall the product, be transparent, be authentic, own up, don't try to cover up, do this through various mediums, like, press conferences, media interviews, reassure investors this is a one-time thing, and, there was a problem and we fixed it and it won't happen again. It's basically consistent, repeated, transparent, authentic, credible communication. That's basically investor relations in my mind. So, so obviously you need a plan in advance. It's a little bit like a cyber attack. A cyber attack is, I often joke, like COVID. You're going to get it. It's a matter of when. So it's better to have a plan. So have a crisis management plan figured out ahead of time. Have a little bit of a playbook in terms of, because when a crisis happens, a lot of us lose our cool. So it's nice to have a list of written down instructions to follow. And of course, things have changed since the Tylenol days because now there are multiple media outlets. You have to worry about the press, social media, conference calls, online forums, webcasts, squash rumors and miscommunication, which is a new problem in our world. Somebody is going to write some, malicious, bizarre, crazy thing on X or somewhere about the company. So it's going to factually, without getting super emotional, squash the rumor, kill the miscommunication, worry about regulatory implications. Is there something here that the SEC can go after? There'll almost certainly be a class action lawsuit, which you need to kind of think through ahead of time. Manage, stock price volatility. That's another important problem, right? Because that itself becomes the basis for a lawsuit. So those are some thoughts about how to deal with a crisis. In terms of growth, I guess it's a relatively easier story because you're not fighting a fire. It's communicating good news is always much more pleasant than communicating bad news. So, but don't overpromise, don't overhype would be my recommendation. Find the drivers of growth, clearly articulate what is our secret sauce, what's our competitive advantage, how big is the addressable market, do we have transparent and justifiable forecasts for growth. It might not even hurt to maybe have ranges. I'm not a very big fan of specific numbers because that puts a lot of pressure on management to go meet those numbers. It's better to have scenarios. Nobody knows the future. Management knows a little more than perhaps the investor. So leveling up, always coming across as transparent, honest, without, of course, giving away confidential information. The other issue I would talk about with growth is that find the right shareholder clientele. IBM is a classic example of a company that's in the tech sector but has value investors. And who are value investors? These are people who want dividends back and stock buybacks. So if you're in a growth sector, you want to invest, not necessarily pay out a lot of the cash flow. So, and that's a function of who you have as investors. So the job of IR in the growth phase should be go try to find growth investors. You don't want value investors, people who don't necessarily want dividends, people who want you to reinvest, because that's quite important. And IBM is a good poster child of sadly the opposite, maybe the only value stock in technology, although it's going up now a little bit because of excitement about quantum and AI and so on. So find the right clientele would be the other point I would say from a shareholder standpoint, and proactively address any negative sentiment about the stock. So
Okay.
maybe that's much more than what you wanted. But
No, that's great. And I think there's a follow-on question to this, Shiva. So
yeah.
a few people have been asking the same thing as Parul, and they say, what shouldn't you discuss or what should not be discussed during investor relations meetings and communications? What do you avoid?
It's a good question. It's hard. Oversharing is the first thing that comes to mind, because the more you say, the less you heard, is unfortunately, like old folk wisdom, but still true. Worry about Reg FD. Reg FD, for people who don't know, at least it's a US rule which basically says you cannot communicate different things to different stakeholders and not make it public. So that's important, because can you communicate new market moving public information in a small forum without putting out a press release? Legally, the answer is no. But it's a tricky balance. When a CEO or the CFO goes up there to talk about things, you're not a computer, and occasionally something will slip through, or maybe there'll be something in terms of body language. If you're a person with a lot of affect, that's actually a problem, because you might communicate more than you probably want to with your affect. So those are some issues to worry about. Some of the obvious points: avoid overhyping things, avoid inconsistent disclosures, don't come across as though you're not listening to concerns. Again, a lot of this is common sense, but as you know, common sense is not common. So
Yeah, can go ahead. People love examples, Shiva, as you know, and kind of mini cases and stories. And Scott says, can you share any examples or recent examples of effective investor relations storytelling that was a hit, and maybe also something that stuck in your mind as a miss beyond the lift?
So the lift case is both a hit and a miss. A massive screw up, like 500
The
basis points
recovery.
versus 50, but the CEO is a master communicator and managed to kind of paper over things. And more importantly, the fundamentals were better. So much easier when the business is doing well. So you can bring the focus back to the business, back to employees, customers, and so on. A hit, an out of the box pick here, I think, is Jensen Huang of NVIDIA. We had him at Columbia, remember? Phenomenal communicator and very authentic individual. Doesn't come across as a bullshitter. He's like a single-handed IR machine for NVIDIA, selling AI, selling vision in a very authentic, believable way, and getting people excited about the area, about the company, about the product. And he's like an IR natural. He's probably not even trained to be an IR guy. So to me, the standout example of a hit is probably Jensen Huang. I don't know whether he got some awards and so on, or there are IR magazines and so on which I should give awards, but I couldn't think of a better example than Jensen
Okay,
in that
great.
sense.
Yeah, no, good one. Anne is asking, what additional communication channels would you recommend for effective investor relations, aside from earnings calls, investor meetings, and traditional kind of methods?
There are almost too many these days, right? Too many. In fact, it's the opposite problem. We have too many communication channels, as we discussed, right? Online forums, what do you do with those people? How selective do you want to be, or aggressive do you want to be on Twitter? How much webcasting do you want to do? One-on-one communications, of course, with the large investors. But again, one has to be careful in terms of not violating Reg FD. So I would argue you have the opposite problem. There are almost too many channels. But if you want me to go through a list, of course, you'll start with your website. That's something you can easily control. What are you messaging in terms of your own website? Can somebody run a Google search and get to your website? This sounds bizarre and stupid, but it's super important. If you can't run a Google search and get to your website, we have a problem. People can't reach you. Press releases, that's more targeted. Social media, of course. LinkedIn, I'm only on LinkedIn. I'm not on Twitter and Facebook, depending on who you think your customer base is. And this is the other issue. You're also communicating to multiple audiences, not just shareholders. Anything you put out might go to interested customers if you're a consumer-facing company, might go to employees, obviously, because the employees are always looking. So keep that sensitivity in mind as well. It's not just shareholders, because you're communicating both to inside stakeholders and customers. And of course, regulators and the second, third level stakeholders in terms of degrees of separation. You can write investor newsletters, you can have webinars. A lot of people do branding podcasts, which has nothing to do with the company, but let's say NVIDIA is putting out lessons about how to learn AI. Obviously it is selling a product, but it extends it's everything is investor relations at some point, right? Blog posts, of course, analyst conference calls, presentations, road shows, targeted email campaigns, et cetera, et cetera.
Okay. Yeah. And Sujit has asked something linked, if we can go back to the social media points that you were making. And they're saying, can you use social media too much to talk about company results? And what caveats are there around that you
It is
make?
an excellent question. Again, since we want to talk about case studies, I mean, the person who's in my mind abused it the most is Mr. Elon Musk, right? Because you cannot keep tweeting about a company and talk about private discussions and so on social media. So if your CEO is too social media savvy, that's actually a problem. So, in terms of controlling the message. So most people that I've seen usually have a presence on Twitter and LinkedIn, at least, maybe or even on Facebook. There's a company page, meaning a company account and a company handle. And they would usually put out some high level data, earnings was X this year relative to last year. The conference call is going to be held at X and Y time. Very few tend to go beyond that, partly because the IR people are very careful about what they say. The bigger issue is a rogue CEO. Don't want to call him a rogue CEO, but there are people who love to talk publicly. That can potentially be a problem, unless, of course, your CEO is your brand,
Yeah.
like a Musk or a
Yeah.
Jensen Huang and so on.
Okay, I think we've got time for one more question, slightly different direction, but I know this is very much in your space. So Bruce asked, do you have any tips on communicating ESG sustainable impact?
Bad word, right? After what happened on January 20th. It's a complicated time to be in ESG. I would say go back to the basics, worry about values and value intersecting. I usually in class show a Venn diagram, meaning, are there ways in which you can stick by your values as a company, but you can also make a case that it has something to do with cash flows and cost of capital. That's the easiest space to be in, given the political environment the next 4 years. Uh, I would venture out and say being boring in this space is better, is good, as opposed to being adventurous. Uh, Needless to say, DEI is a hot button issue. Just today, I think activists have gone after JP Morgan and maybe Goldman Sachs about diversity efforts. If you're making climate pledges with numbers or targets, be careful because you want to be able to make sure you actually deliver. Otherwise, I'm guessing a lot of companies will simply stop making pledges. They're getting out of alliances. The banks have all gotten out of the net zero banking alliance as well. So if I were to summarize in that space, my recommendation would be focus on the intersection of values and value. Be boring. And don't try to draw too much attention to yourself. You can keep doing what you were doing if you think that's good for your brand and your business.
That's great. Thank you, Shiva, for those specific tips on ESG and stuff, but also for all the insights that you've shared with us today during the session. We're now really looking forward as well to your upcoming Leveraging Investor Relations Exec Ed program, which will be running here on campus, on our Manhattanville campus here in New York, March the 25th to the 27th. So good luck preparing for that. And I hope some of the people on this call will join us in that.
Yeah. And the best part about that is that you don't have to hear a pointy-headed professor like me go on and on. We can actually get people from practice, and we have some excellent speakers lined up. The head of IR from KKR, the head of IR from AT&T, Zotis, and I'm trying to get people from Morgan Stanley. The ex-CFO of Visa is also going to be here. So, and as you know, one of the big things that I often emphasize is Columbia is all about theory meets practice. So I think there's a lot for both professors and people in the trenches who do this for a living to simultaneously be on the same forum in the same classroom. That to me is the best form of pedagogy. And that's, we aim to continue that in the
Yeah, I
program
think
that's coming up.
knowing you, there's going to be less lectures and more discussion and debate and dialogue.
Absolutely. Who wants to hear lectures, right? We want good conversations, tough conversations, but respectful.
Absolutely. Great. So I'm going to wrap up. Thank you again, Shiva, on behalf of Columbia Business School Executive Education. Thanks to everyone for joining us today, and enjoy the rest of your days. Thank you.
Thank you, Mark. Always a pleasure.
Thank you. Bye-bye.